Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Russell 2000 index, ticker symbol RUT. And I've left my lines on the chart from last week's report so you can see how the technical signals are working out. Now, again, as I zoom in here, you'll see this is the line that I drew last week, saying that we would most likely start to pull back and fill this gap right here with a possible test of support right here at these lows, which would be a gap fill point right there as I magnify that for you. Now, what has happened? Well, the market did the exact opposite. It rallied right up to the gap fill resistance up here. Now, if you're a regular follower of the market guys, then you'll know that gaps fill 80% of the time. And then after the gaps fill, there's an 80% chance that the price will reverse. So now that this gap has filled, we're expecting the market to continue to drop. Now, there's reasons why. I'm just going to move this line right here. I'm just going to move this to the right, and I'm going to continue keeping that price target right at the end of this line right here, because this is a 2-week forecast, and there's a lot of signals that are popping up on the chart that are telling me to watch out below. The first thing that we want to watch out for is, again, the fact that there's open gaps below the market. We gapped up on Tuesday here. There's still a gap from last week. And like I said before, there's a gap all the way down here. So I'm going to keep that gap fill support level in place right there. But I want to draw your eyes to the bottom side of the chart here, where we can see the stochastics oscillator right there is starting to hinge, and it's in an overbought condition. So right now, as it's hinging lower, that's telling us the sellers are starting to move into the market. This oscillator down here is the CCI, and while the price of the Russell 2000 has gone higher, especially on Thursday, yesterday the Russell 2000 crossed with a sell signal. Now, that's something we usually do not see. If the stocks go higher, the CCI and the stochastics generally go higher, especially if these stocks are closing on the highs. So we got a sell signal right there. As I magnify that, you can see how the blue line is crossing below the red line. The final thing I'd like to point out to you is that this looks very much like a head and shoulders pattern. With this being a left shoulder, we have the head, and we have a right shoulder. Now, most of the time, head and shoulders patterns form over a series of months or long weeks, I should even say. This is a daily chart, so we don't put as much weight into a head and shoulders top found on a daily chart. However, that is still telling me that if we don't get up to the highs back here and break out into new high territory, the market could be exhausting, and the buyers will most likely start to pull back on the buy pressure, and that would lead into selling and possibly even short selling. So again, the Russell 2000, I'm expecting that to move lower. I'm going to put a 2-week forecast out just like that, leaving the resistance up at top, leaving the support down here on the bottom. So we're more or less stuck in a very wide trading channel for the Russell 2000. Now, if I look at the diamonds, this is the DIA, the Dow Jones Industrial Average ETF. You can see similar pattern here where we have a higher high, but look at the sell signal on the CCI right there. You see how the blue line crosses the red line. We also have gaps below the market, and what we didn't have on the Russell is the chart here on the diamonds is showing us that the volume is slowing down. Now, that is very significant because volume is a leading indicator. If the prices are moving up, like we see they've moved up here, but the volume is dropping, that's telling us that the buyers are running out of some of that momentum. So I'm going to erase all these lines right now, redraw right to the gap fill point. So I'm going to do a 2-week forecast again, all the way down to the gap fill support, which will be right here. And then we're going to have to wait and see what happens with the diamonds. Now, finally, if you look at the CCI, I'm going to zoom in just a little bit for you. You can see that on a higher high right here from the 12th of February, we see a higher high than the high that was reached on January 17th. You see this right here? But we are seeing a much lower high on the CCI. That's known as a negative divergence. So while you might be tempted to continue to buy at these high levels, I would say take a defensive stance. I would, again, keep an eye on the charts, but refrain from buying heavily, especially at the highs, and look to protect any long positions that you might have, especially those that have profitable, unrealized profits in those accounts. So be careful of the diamonds. Now, if we look at the Qs, ticker symbol QQQ, this more or less represents the tech sector. We see much higher highs than we saw last week. But look at this. This is the first time I've seen this in years, where as the prices are steadily moving higher, we see that the CCI is steadily moving lower and also crossing with a sell signal. So we have a wide divergence from this 20-period moving average. We have a drop in volume on the highs right here, signaling a lack of buying pressure. We have the stochastics overbought right there. It's reading over 80, so that's an overbought territory. And again, that CCI showing that negative divergence as prices are going higher, the CCI is dropping. And finally, we have a gap below the market. Now, for our Oracle subscribers, I put out a trading checklist, and that really helps you more or less weigh the evidence on the buy side versus the sell side. And right now, the way I see it, all indications are pointing lower. So I'm going to move this out again with a 2-week forecast with a move to possibly fill this gap, and then maybe we'll see a bounce at this established support level right here. Now, if you're interested in getting a copy of that checklist, then just send me an email. I'll be more than happy to email that to you in a PDF format. Just AJ at the Market Guys will work. We have people monitoring my email box, so don't worry about not getting an answer. You will get an answer. You'll get that file sent to you, and I'm absolutely certain it will help you weigh the evidence, like I said, to determine which way the signals are stacking up on the technical charts. Now, if we look at the spiders, that's ticker symbol SPY, same story right there. We have higher highs after a bullish engulfing pattern here on Monday. We have higher highs, but look at that CCI heading lower with a sell signal. We have a gap below the market here. We have another gap below the market here. I'm going to run that forecast out again 2 weeks out to fill that gap. That's my forecast. And we also have a wide divergence from this 20-period moving average. We call that the rubber band effect. Go to themarketguys.com and you'll see a short video that explains the rubber band effect and how to use that as a tool for managing risk and taking positions in the market. Now, the only difference here in the spiders is that we have a very small candle here that's a doji, almost a spinning top, more or less, but we have an increase in the volume. So that's the only market that I'm seeing right now that's showing an increase in volume on the way up. So that's still showing some strength. So we can't put that on the bearish checklist. That's still bullish. But the fact that there's a wide divergence over that moving average, that's bearish. Gaps below the market, that's bearish. The stochastics overbought, that's bearish. And the CCI dropping as prices are going higher and crossing with a sell signal, that's extremely bearish. So look at the SPY, and then as soon as you look at the SPY, look at the VIX. The volatility index is a leading indicator that's a contrarian leading indicator to the S&P. I said we would rally. We didn't, but I'm going to keep that target right in place because I'm going to, again, go out 2 weeks with a 2-week forecast. I'm going to put my target right where I had it last week and just shift that on over to the right. Look at the stochastics on the sell side here. We have an oversold condition. That's the lowest it's been since we had it back here in October, right here, back here in October 15th. So we're showing an extreme oversold condition on stochastics. The CCI is oversold. I do expect that that will start turning higher just like that. Keep that in place for next week. We'll watch to see whether or not that happened. And there is a major support level on the VIX right around 1170. So that is most likely going to hold. But I think between now and a couple of weeks from now, we're going to see much higher levels on the VIX, which in turn is bearish for the S&P. So stay tuned to the market, guys. Each and every week I put this alert out for you so you can at least manage risk and know where the break points are, where support and resistance levels are, where the pivot points are, and how to read the candles so that you could put the odds in your favor as a swing trader or investor. So have a great long weekend. Remember, the markets are closed for President's Day on Monday. So that's going to lead us into a shortened trading week, which could be interesting because next Friday, is options expiration for the monthly options. And when you combine that with a shortened trading week, that usually adds to the volatility. So that plays into my forecast that I just gave to you right here on the VIX. So again, have a great weekend. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.